Okay, let's see. How about now? Is sound working? Can you understand me? I think I fixed the problem. I think I fixed the problem here. Oh, now it's double sound. No sound still. Interesting. Great. Uh, Working on this. Sorry, guys. Just one moment. We're working this out. Thanks for bearing with us here. Okay, sound is now available. Great, great, awesome. Thank you, guys. Okay, we're gonna blaze ahead here. That we got the technical difficulties out of the way, now it's all good stuff. So, Fibonacci trading decoded. We're gonna be talking about some really good stuff about how a range forms in a market and how we negotiate that range, trade ideas, and all sorts of good stuff. Thank you for bearing with me. We're cooking now. So, let's get started here. We're going to be going over some core Fibonacci tools that I use and that are really applicable to everyday trading. We are going to be talking about some more advanced concepts like how they interact with market structure, Fibonacci extensions for targeting breakouts, and as well as a little bit of time and price harmony as well. We are going to be going over some common pitfalls. Just like always, I always want to walk you through what could go wrong. We got to be prepared for contingencies as traders, but it's good stuff. This is a really good system. It can be integrated into whatever trading system you have. If you don't use Fibonacci's and you start throwing them on your chart, you're in for it because you'll just see things popping out at you. It's awesome. It's really cool stuff. So after that, if we have time, I'm going to go over some live trading examples from the past couple days while they're still nice and fresh. We had some really good Fibonacci action, and if anybody, as we're talking today, you'll notice that I'm going to be mentioning a setup that we got today in the market. So if anybody catches that before I can call it out, by all means do it. You get a gold star. So after that, we'll do some questions and answers, and yeah, it'll be a good time. So let's get into it. You might have seen the seashell on the first page and the succulent leaves here. It's because Fibonacci's are a pattern of a number sequence that appears constantly in nature, everywhere from your blood vessels all the way to not the Nile River, like the tributaries of a river. It's something that for whatever reason seems pretty intrinsically ingrained in nature. And I don't know, maybe that's how our brains operate too, or maybe it's just you're aesthetically drawn to these things, and so that gets emulated in our market behavior. So the important thing to note is when you throw these lines on a chart, you will see prices react to them. It's pretty wild the first couple times you do it because it feels like a cheat code. It's really cool stuff. So we're going to talk about some of the most core kind of Fibonacci levels, and then we're going to get into a little bit more granularity. I'll tell you what I have on my personal Fib setup, but let's go over the really important ones first. So we have the 62 Fib, or the 61.8 Fib, if you want to get super specific there. And you have this important level, and you also have the 78. And so between these two, it's referred to as the golden pocket or the golden, what's the name for it? I call it the golden pocket. But essentially, when you have a range, so you come down, you make a low, come up, make a high, and you've established that range. A 62% retrace of that, and then a 78%, that is the optimal time usually to buy if you believe the price is going to go higher eventually. So we're going to talk about the reasons for that. It's really interesting stuff. But this is how institutions use them, and they trap retail traders by doing this. They can create what to the untrained eye looks like a lot of noise on a chart, but in reality, what it is an efficient sweeping of a range. So it's basically as price negotiates between that low we put in and the high we put, we're trying to basically generate as many orders, as many transactions as possible. The market makers are. So because of that, you'll see price sweep this range and basically collect all of the unsure money, so to speak, in a very efficient way. And these bids are very important in that. So we'll be talking about that for sure. And we're also going to be going over like the difference between like random retracements and high probability retracements because some you got to give more weight to than others. And a lot of that is informed by your your higher time frame bias. So if your high time frame charts, like your daily, your weekly, your monthly, if they're pointing up, then you're looking for these retracements down to get a good entry for the range to expand above the top of the range and, on outwards. And so we'll be talking about, where to target for those range breaks too. There are some key Fibonacci, levels there that, act as really, really good just take profit levels. And, yeah, it's really good stuff, and it's very replicable. You'll see this day in and day out. Like, I have the one example from today's trading, but I know that if I just pull up yesterday's chart, I'll see a bunch there too, because it just happens every single day in some way or another. So, yeah, super important stuff. Thank you, Will, buddy. Yeah, they are nice plants, especially when I remember to water them. It's been hit or miss with all the exciting trading this week. So, thanks for joining. Good to see you in here. So, let's talk about some core Fibonacci tools. So the math behind the markets is all in these Fibonacci levels. Like I said, they're about sweeping a range in a very established, very systematic way. And it's basically extracting as much liquidity as possible from that range before progressing to the next range. So we talked about the golden ratio, and that's basically you'll see that in a sunflower, the seashell, or those succulent plants, but it happens in markets too. That's why that 62 bit is so key. So it represents, like I said, the optimal pullback depth for institutional entries. So today, this was actually the QQQ chart for today. So we came down in the morning and we pushed up. We formed a nice big range, and then the retrace came right in this golden pocket between the 62 fib and that 78 fib. So the 62 is considered like optimal for if a chart's moving really tight and it's just working as planned. Like this is considered a deal. And so let's talk about it. What is it? What is it? What am I saying when I'm saying you're getting a good deal on this stock? So think about it like this: you have a range, and this is where all the prices are distributed. Right? People are buying here and here and here all the way up. So in this range, if it's under 50%, it's considered at a discount of the range. And up here would be considered a premium. So when you're looking to go long and you see this range and you're like, okay, this was a nice spike of a move on volume in the morning, you can't see anything. Oh no, it did not switch over. I'm so sorry. Let's go back over there. Apologies there. I'm trying to juggle between two interfaces and I'm still learning. One moment. If I do this, I bet you see it. Did that work? Yes, it did. Okay, thank you for bearing with me, guys. We're gonna talk about this chart here. This is Qs, and this is the range from the morning up into the highs here. And so, sorry, what I was saying is that here's the range, and this is the equilibrium. So anything under here is at a discount, and anything over here is at a premium. So if it's at a discount, if you're expecting the stock to move up above this range and break out, like so many people are right now in the market, then we will be looking to accumulate a position at a discount. So we came up and we came down, and here's the 62 fib, and then here is the 78 fib. So this is the kind of optimal entry. And as you can see, there are a lot of bottom wicks here. There's a lot of consolidation in this price where people are trying to establish a long position. Then we have a big stop run here. And so this is optimal, and this is like where they like to run stops. Because if you're long, say from the middle of the range, or say you got trapped up here, this feels really bad. And you're basically digging back into the deep support that was formed in the morning. And you're using this area to kind of gauge, okay, if we come down here and retrace really quickly, this is a really good long entry. So what this allows us to do, and what market makers are doing when they're taking a long position here, is that it gives them a latitude to trade within this range, because some ranges take longer than others to transact and then move above. So, for example, they might be getting long here, but then at the middle of the range, or maybe up here at this 0.38 fib, which is essentially the mirror of this 0.62 fib, they're taking some of their position off. So they have this big range, they're buying long here, they're selling some here, they're selling more here, then it comes back to their optimal entry. So this is what I mean when I say efficient negotiation of a range. This is the way that the most money is to be made in a given range, so to speak. So because of this, we're able to really manage our risk a lot better, right? If we're sniping entries down here and we're taking profit up here, it's okay if it comes back. In fact, you'll probably want it to because it'll be going to plan. So we're going to talk more about this. We're going to talk about how to use these entries and then where to target it if you do get your move and we break above. So we have some strategies to talk about here. Um, when you are when you're trading a range, there's kind of a few steps that you want to look for. So the big thing is that you combine the retracements with swing highs and swing lows. A lot of people will kind of arbitrarily place Fibonacci ranges in just any 2 points on the chart, and they'll look at fits. But it's really important to use those highs and lows because that's kind of it's kind of I mean, it's the only way we can really measure how a chart is moving, right? It forms a range, and then we watch what it does in that range. And yeah, it's good stuff. So we're going to talk about that. For profit taking, what I really like is the 127 extension and then the 161 extension. So in the same way with the other chart, how it came back and shook people out at that 0.78 fib, it will sometimes fake break out of a range, and it'll very often go to this 127 fib before it kind of gives up and then goes back into the previous trading range. So because of that, if you're not 100% sure of the breakout, it's a really good idea to take some off the top there. And then if it comes back and it back tests the bottom or the top of the range and then pushes there, you can add that part back. So I really like the 127 for that reason. It allows a lot of versatility in your trading, and this is really good for futures traders or prop firm traders. I was doing this all day in my Trade the Pool account because they allow you to to get in and out of positions. You don't have to wait for settled cash like with a Robinhood or a Spike or Webull account, something like that. So it's really good for active traders and the institutional traders and of course the market makers. They're trading constantly, right? So if at the very least, even if you're just trading options or whatever, and you don't have the flexibility to get in and out like this, it's still really good to know what the market is doing and why, because it'll change what you might view as aberrations on the chart as into something where it's systemic, and you're seeing, oh, this is what they're doing. They're sweeping this range, now they're coming back to this core level, and then they're pushing off. So on this chart here, this I just kind of was going through my charts and just I pulled it all the way back on Apple because I wanted to see some nice retracements. And this is a weekly chart, I believe. And we have low here, and we have the high of this range, just a big squeeze. So say you were bullish Apple, but you missed it down here. You missed it up here, and you're like, I can't chase this. It's just going straight vertical. Like, what are we doing here? We can't chase everything, right? But if we know we want to get long and we know the stock has a strong incentive to move up like this, what are we targeting? We are targeting these Fibonacci pullbacks. So as you can see, this was a really strong move. So you can expect not to get too much of a discount, right? Remember, discount is under this red line, under the 50% of a range. So as you can see, as soon as it hit discount, there were some significant buying pressures, and it just kissed shy of the perfect optimal entry. And so you don't let it scare you away if it's not quite getting there, and you're like, oh wow, there's a lot of buying power right above this fib. So that can also be a little sign, a little tip of the hand from the market, right? That's saying everybody's just chomping in the bit at the bit to get into this thing. So maybe it doesn't hit it perfectly cleanly, but these are rough zones, right? It's kind of like just dividing the range into different segments and assigning characteristics to the people who are buying it in any given part of the range. So like people buying here, they're very bullish and they expect the range to go higher. And anybody selling here, you can see there weren't many, but they're probably expecting the range to go lower. And so we're kind of comparing the strength of the buyers that are like bullish, of the people who are bullish at it, buying at a discount, to the amount of downward momentum that the sellers in the top half, the premium of the range, can generate. And this is all going to help you build a bias. So as you see the range forming, you can use all of these little tools and tips and tricks to help inform your bias about whether we're going to break up out of the range or down. And there's a lot of art to this. It's not always as clean cut as this. There's a lot of kind of let's just call it noise. And I'm sure on some smaller time frame, the noise would make sense, and you could do Fibonacci ratios on your 10-second chart. But for all intents and purposes, you got to expect a little bit of shake and bake, a little bit of stop running, and just kind of it's just kind of important to remember what the purpose of all this is. The purpose is if we're looking to break up out of the range, we're looking to buy at a discount, and we're looking at the 62 fib, and we're looking at the 78. That's a golden pocket there. So there are also tools you can use to do Fibonacci sequences on the time horizon as well as the price horizon. So these are a little more esoteric, and they're kind of very tied to cyclicality in stocks and time cycles. And there are certain things that are more tangible that are really good to know. So just for example, I mean, yesterday we saw a crazy squeeze at the end of the day, right? I mean, that was a pretty wild move. And this is why it happened. It was at the end of the month, and we were saving that monthly candlestick from going red, and it was just a lot of what's called window dressing, or hedge funds basically at the end of the month buying the things that their clients are gonna want them to have on their reports. So, if it this is a part of why I'm pretty bullish on Qs right now, at least for the next couple weeks, because people are thinking that it's a good idea to be long Qs right now, long QQQ. And so, yeah, because of all these reasons, I caught the squeeze yesterday, and we can go over that chart and talk about what I was looking for. But the important thing to remember is, like I said, you got to have these higher time frame biases. So because I knew that they were going to try to push it at the end of the month, and because I saw it basing under that end of the month level, I was like, oh wow, they're going to have to make a move really quickly to match that time horizon. So just a few more things to think about there. So let's talk really quickly about some pitfalls that people can fall into. The first one I mentioned briefly, but I want to touch on it a little bit more, and that is the "I see fibs everywhere" syndrome. They're driving down the highway, looking at the mountain range. So that's a 60% retracement. Like, just because you can put a fib on anything doesn't mean you should. So, like I said, it's got to have a solid low and a solid high, and it's all contingent on what time frame you're trading. So, because somebody could say, well, the high and low of yesterday that we were just looking at on Qs, that's still a part of a bigger range. Absolutely. But we're negotiating the current range. And so we wanna have an established, like, okay, if I'm a day trader, there's the swing low of the day, there's the swing high, there's my range for the day. And if you're just trading on daily charts or weekly charts, then you can have those discussions, and then you can use these small ranges to kind of pinpoint entry. So just like Fibonacci's are fractal, and you'll see them in your blood veins, and in the on your cameras from space when you're looking at rivers. It's the same within a chart. These happen on a daily time frame, on a sub-daily time frame, and on higher time frames as well. So it's important to basically have anchor points. That's what I'm trying to say here. Don't just slap a fib on two little points in the middle of a day and say, okay, this is what I'm basing my trade off of, because that's just kind of noise. And there's information to be gleaned from that, but it's not going to be the take home here. The takeaway is that we have an established range, we're trading in that. And another thing is that you can use Fibonacci's in kind of suboptimal market conditions. Like if there's news coming out, it's really hard to kind of rely on any technical indicators. So this isn't specific to Fibonacci's, but it's just always important to remember that TA works by looking backwards and extrapolating forwards. And what changes the trajectory that technical analysis helps us chart are changes like that we couldn't have foreseen. So if Trump tweets something crazy, the market's going to react to that. But then that'll set a new range, and then you can use TA to watch that range negotiate. So just don't bank on these working 100% if it's a big volatile news day, if it's CPI or FOMC, something like that. Just remember to take all technical indicators with a grain of salt when there's large volatility entering the market in the form of unknown conditions. So the last thing, you're probably sick of me saying it already, but you gotta keep in mind your higher time frame biases. So I was looking bullish because for a lot of reasons, but the gist is that on the higher time frame charts, things have looked constructive this week. And so because I'm betting on a push up, I can use that to help inform my buys. So today I was a buyer in that golden pocket today, that 62 fibs. And it worked very well. I wish all my trades worked that well, but that trade did work quite well. That is also why I think I'm bullish for the next couple weeks here, probably until something gives me a sign to say otherwise. Because everything is telling me that when these intraday ranges come back to these optimal buy zones, they're hammering the buys. People want to be in this market. So yeah, there's just a few things to kind of keep in mind in terms of what to watch out for. And just remember, these Fibonacci's, they work best when the market gives you really clear swing points. So, you don't have to force it. You can wait for these ranges to develop and then trade inside of them. A lot of people only want to trade breakouts, but you can catch the breakouts with these intra-range entries. So real quick, let's stop and do some Q&A, and then I can jump into some live charts and take more questions there. We can get kind of nitty-gritty as you guys want, or as broad looking as you guys want. I want to tailor this to what helps you guys. So, um, while I'm getting some questions here, I'm going to flip over to my charts. I'll share this here, and I'm going to do the same in Discord for the Discord watchers. And then we will talk about some examples. There we go. Oh, heck of a move after hours there. Wow. Alrighty. So let's go over a few things first. So for intraday trading, there's a few things here. This was the move up and down. And so I got long in here and I was getting out. I took a little off at the 50%. I'll zoom in here and some more off here. And then I was looking for selling to either come in here if we were going to go down, or I was looking for buyers to kind of step up when we would dip under these key levels. So for this part of the day, it was looking pretty constructive. But right around here, I got really worried because we were not able to push up. If we were going to break out of the range above immediately, I would really expect more oomph here, right? And we just weren't really seeing it, especially into close here. I had to stop trading around midday, around this part, but this kind of helps confirm that bias where, I mean, this is acting like it wants to test lower here, right? So I'm curious, if we switch this fib, look at that, right in the middle of this golden pocket. So between the 6.2 and the 7.8, you'll see that some people really got great entries for a short position to break this range. So in any range, there's a lot of sweeping going on, but it's all giving you hints about the break. So you can look at this on the smaller time frames, like I did. I was just day trading this, just scalping this, and this was good enough for me getting long up here. Let's flip that back around. So you can always find a nice little trade, even in ranges that maybe aren't going to break in the direction that you thought. Still can't see the chart? I'm so sorry. It says I'm sharing it. I just reloaded it. Okay, there we go. Sorry about that, guys. So I'll go over that again briefly. We had the range here, and I was getting long into this golden pocket just to look for how it was gonna act on the premium side of the range. But if we flip the Fibonacci ratio around here, we'll see that the bears, they got their optimal entry right in mid-afternoon here. So it was right over the 62 fib and right under the 78 fib. And when it tagged the midpoint there, you can see really strong selling incentive when it got over this fib. So these guys had it right, and they got their move to the break of this range. So now when you have a small range that breaks, what do? We zoom out a little bit, and we're gonna redraw our fibs to encompass the larger range here, because now we have a clear bottom of the range, and we have a clear top. So in this new range, let's see what we can learn here. Still a lot of room. I would expect it to come down right around the 475 handle just because it's the previous zone of support here, and then it lost it and regained it, and that provides a confluence of reasons why I would wanna revisit this. There was a lot of volume traded here in this kind of mid zone. We can see it for the past week, kind of consolidating above and beyond this pivot. Let's draw it out here. Right about there. So we are gonna watch this area, and what we're looking for is how is the relative strength of sellers in this range compared to the relative strength of buyers in this range below. So there's a lot to be said. Excuse me. There's a lot to be said for just staying agile and remembering that these ranges right here, for example, are always part of a larger range. And for example, let's go over to SPY really quick. On the daily chart here, we have the big range from all-time highs to lows. And as you can see on the tariff pause announcement day, we surged right up to the 50% of it. So this is one that I didn't mention in the slides as much, but I want to talk about it just as a sense of a good bellwether, a good metric for kind of keeping an eye on in any given range. We want to see what happens here. So when we slam up into it, but then reject, it probably needs more time to consolidate down here. So we can switch this fib around, and we can see on this higher low, this second part of the double bottom that formed, buyers got a really clean entry right on the 78 fib. They ran stops, and they even ran stops from this low of day here too. So very sneaky by them, but you'll see this a lot. And whenever you see this level, this 78 level getting dumped and then reversed, this is a great buy point. So because of this, we surged back and we tested the middle of the range here. And as you can see, after a few days of consolidation, it seems like we're pushing up. So now this is the smaller range we were looking at, and we want to see what happens when we kind of fill this gap, when we kind of test back into this previous gap. And basically what we're doing is we're efficiently negotiating this larger range. So what bulls don't want to see is they don't want to see sellers step in over this 7 or 62 level, which is what we have seen. So we got to keep in mind that it probably means that we'll retest this middle at some point. We'll have more information when it tests this range's middle, but it's all about just kind of keeping tabs about where you are in these larger cycles. So there's some food for thought there. It was a pretty wild daily candle, the gap up and then close near the lows and then pushing down after hours. So we did just about fill that gap. So we'll see. It's interesting stuff. I'm gonna check for questions really quick. Just questions about where's my chart. I'm sorry, guys. I have a lot of windows open here, and I'm sure I did something dumb, but we're going to be streamlining this going forward. The next one will be smooth, I promise. So some interesting fib stuff here, and I think I had an example on the daily chart or intraday chart from yesterday. QQQ. Go ahead and hide this fib. And we will trade from yesterday's high, clear high there, to this low. So remember, we're looking for, in this current range, we're looking for hints about where the market's going by how it's acting under the 50% and how it's acting over the 50%. So what we want to see when it's under is swift buying, basically like a beach ball underwater. We want the market to be showing us that, hey, it's just like if your favorite item's on sale at Target, right? You want to buy it while it's cheap because you know that it's good and it's going to be more expensive in the future. And this is the time to essentially. So we didn't quite get the optimal entry, but again, that's a sign of strength, right? We're just watching what happens under this equilibrium or this 50%. So because it was so eagerly bought up here, I was very, very willing to be biased on a break of these pre-market highs. And so I was getting long in these wicks here, and I was holding cash. I didn't get a position on this because I was holding cash for a tap of this level, and I never quite got it. But once I saw the strength off of this, I was a big buyer. I think right off this level, I have marked 68.40. So yeah, that's kind of what I was looking at there. And then I was keeping an eye on what happened at these levels too. So this is where I got out of the trade. I got out right there. And then I said, okay, I need to see what it does when it comes back. And let's see if it can get to the midpoint. But ideally, I want to see it stay in the top half of the range. So I got out right there. And as you can see, it worked out pretty well. And then I was sitting here watching the 68 fib. So it came down and I wasn't quite willing to buy yet because I thought it could go lower, but then this candle started to show real strength. So I was nibbling some here, and it was just hanging out, just hanging out, and every time it came down and it showed like it didn't wanna go lower, I was just adding a tiny bit, and my stops were just right under this low here, so it was like, you can really manage your risk with these Fibonacci levels because basically my logic was this: "Okay, we came up here, this is a logical place for people to sell. If we're gonna break up out of this range, I would expect it to hold this next Fibonacci level down." So it came and formed a mini range, and in this mini range, it started to kind of push up out of this, right off of this support, the 62 fib. So because of that, I was just taking little bites there, taking little bites whenever it would start to reverse and show that it didn't wanna be down here. And I wish I could tell you I held through all of this. I sold at high day there. I had a runner for this high day for the actual range break, and as you can see, the range from yesterday's high, it got wicked above and then sold. So I was all out there, and then earnings came and Microsoft blew the roof off. And as you can see, kind of a blow off top there. But this is just an example of how any range can give you a lot of information about the overall directionality of the market. Let's see. So we've been going about a half an hour here, a little more. I'd be happy to answer some questions if we have any. Otherwise, I can run over some trade ideas I have here until you guys get sick of me. But in general, I think that it's just really important to kind of go back and touch on the key points. So always keep an eye out on how price acts in the discount of a range if you're bullish, and in the premium of the range if you're bearish, because you want to get little hints that your bias is correct. And always use higher time frames, like for the daily time frame. This Fibonacci range has been dictating my trading. This whole craziness up and down. I've been watching these levels very closely. Flip that back around. Yeah, for reference, remember this wick run right here. And then just it gaps over this key level, holds over the 50. It's giving me information through this whole one that there's a good chance that we want to test up into this optimal sell zone. So we did tag it a little bit. I think that we dig a little bit deeper and we get this 200-day moving average. We heal this little gap right here, and we get all the people who are long into Liberation Day. This candle right here, when the tariff news got announced and the market just cratered. We want to get them an out basically, because when you're looking at areas with a lot of volume where there's a sharp move from them, think about it like a magnet on the tape, a magnet on the market maker's books, and they see all of these people who were long here, and they're saying, "Hey, just get me out break even. I'll be so happy. I won't ask for anything else. Just get me out." And then you get to transact all of these orders. So there's a ton of orders on the books up here, and that usually acts as a magnet. Because of that, I really think that we're going to tag that, and then I'll be watching that very closely because it'll also be right inside this potential sell zone. So that's what I'm thinking happens. We trade down a little, we trade up, we get all of the people out from Liberation Day, and then we got to watch really closely. And if there starts to be some downward momentum, I'm going to be getting short into that, and I will be targeting this 50% retest. So basically, the high of that tariff day candle. So I don't use fibs for everything, but they're always at least a part of my bias for a day, for a week, for a month. It's really, really helpful to just kind of keep your bearings within any given range. So let's see. I think that's just about all of the basics that you need. There are some more advanced concepts. We can talk about range breaks too, extensions. I don't think we talked about that too much yet. So how about we go look at yesterday's price action, and we can project that range outwards. So this low to this high, we see we have some targets up above, right? I'm going to add that one that I mentioned, the one, there it is. Put that in green. And we'll put this in green as well. So these are our take profit levels, right? We have this range, and then we're saying, "Okay, we're getting long in the golden pocket and we're gonna break above." Where do we take profit? Well, if it's a fake breakout, they might go a little bit over, it's a decent amount over the 1.27 and then reject it there. So, when we surge up to here, I would be taking some off, and then I would be waiting to see if we can hold, like, the previous little swing low, or basically any hint that the market might wanna reject. If it does reject, it would look like a big engulfing candle, a big move up like that, because a lot of people are pushing this 1.27, and then we would lose that level right there. So because we didn't get that, it would be safe to target the next one up, the 1.68. And, I swear I didn't plan this example, but look at that kiss right there, just boop, right to the penny, just about. And then that was the end of the move. So that is a very, very good big meaty move, great target, you take that trade, you get in right here, you get out right there, overnight just about. I mean, that's really good money, right? So what these fib ranges can help with is you can capture the meat of the move there because you don't have to get chopped around in the range. You're buying during the chop, your optimal buy zone, and then you get the expansion right to your target. This happens a lot, I promise. So we got a question from Aaron. Do you do retracements off of the wicks or the candles? That's a great question. So this is how I would look at that. When you have the bodies of a candle, it represents big money, institutions, large traders, people who are using size. So they're the ones where the move really starts, right? And then I look at the wicks, like kind of the retail noise. So it's not that I don't give them validity. It's just that I think that they are less important in terms of the overall trend. So for me, I think what's most important is you either draw wick to wick or you draw body to body. Both are valid. So I like to draw wick to wick just because it's often the case that when they sweep stops, they will sweep those wicks as well. Not always, but often. But let's try like on, I think a 15 minutes is a good time frame. We can draw from the top of the body candles there and the bottom here, and it's going to be roughly the same. But see how it kind of overshoots it a little bit, and it wasn't quite as clean when we have it drawing wick to wick here. You get a lot cleaner of levels, I think, level responses here. So for me, that's just watching this stuff a lot. It's not always so for small caps, I will give less weight to the wicks, and for large caps, those wicks still hold significant volume to some extent or another, so I give them a little more credit, if that makes sense. Oh, yeah, great question. In general, just remember that the bodies of the candle are the big money, and the wicks can be often a little bit noisy. It's like the retail traders kind of chasing, selling the bottom and, buying the top and those kind of blow off moves, and they're just less valid, I would say, from a technical perspective. All right. Let's see if there's anything else that we can glean from some ratio charts. I'm just going over the stuff I've been trading recently because, hey, this is good for me too. So what we can do is we can just literally draw it on any range. But first, let's draw it from. So we've got a lot of chop. Where would we draw the low? Where would we draw the high? I think the low would be right here, and then the high would be right there because that's a nice clean swing. It's kind of after an expansion, right? So this was a previous range, and then the range that was, wherever you want to consider it, we'd have to go back pretty far to actually see because it's a pretty big breakout. But the gist is that it broke above and it kept showing willingness to move higher. So here's a nice swing low after this impulse move, and there's the swing high. So here's the impulse move, and this is the consolidation here. So we have this range. And I know I'm a broken record, but let's see what price does under the 50%, under the equilibrium. When Bitcoin's on sale, when Bitcoin was on sale the past 2 weeks, what did buyers do? They were all over it, weren't they? It dipped into our optimal range only twice. And each time it did, within an hour, it was back up over it, right? Sometimes a lot quicker. So this is part of why I was so bullish and why I'm still holding Bitcoin long. It's one of my biggest positions right now. And it's because this chart just wanted to go up. And sure, like, this was unfun, but I said, "Okay, it wasn't ready to go. We need to see what it does down in this golden pocket." And I was thinking it might run this level, that stop run level. And, as you can see, I have this, drawn out as previous support. Let's go to a daily chart. Yeah, we had this wick high, and then we surged through it, so I wanted to see this previous resistance flip to support. And you can also, if anybody caught my order blocks or my ICT concepts trading idea or trading webinar, what was it, last week? You'll remember the concept of order blocks. We can talk about that really quick. An order block is when price comes down and then reclaims the level, forming a block of support. And you can think about this move from the down to up as basically bulls down here having large orders on the books. Market makers are like, hey, look at all these orders down here. We're going to bring it here. And then all those orders transact and they're buyers. So then price surges and traps sellers. And then anybody who's like here, short, they get stopped out and they have to chase the move up to cover. So that's why I was looking for this area and I wasn't worried about these kind of dips here. And as you can see, it just keeps on moving up. So it broke this range. And now let's flip this around and see what we can maybe expect for some targets for Bitcoin. See, it's at a key level though, because it swept this 1.27 and then there were some sellers. So how I would view this is, okay, we made the little start of the move. Now, if it's real, we want to see consolidation and we don't want to see a big rejection, right? So to me, this is looking really good. To me, it just popped this top and now it's just kind of hanging out flagging again. So personally, I'm still long. If we lose these levels, lose view out, for example, then I'll be a little bit more to probably take some more money off the table. I tripped this 1.27 extension, and now I'm just hanging out. What I think we're going to do is we're going to go for this 1.68 level. I think that extension is very valid. I think that the higher time frame charts really support that too. But here's where there is some nuance to it, right? Because let's hide this. I want to show you guys this bigger range. So we have the high here. Actually, okay, let me show you two ranges. This is actually a really great example for fibs. So Bitcoin, from this swing low to this swing high, you got to be a bull, right? Crazy cup and handle breakout. Where do I buy it? If it's like right here on the way up, I can't chase this here. Where do I buy it? So I wait for the top to form, and then I wait to see what happens when price is offered at a discount. So the discount, remember, halfway between the high and the low, that red line there, the 0.5, every single time it went under there intraday, except for this one day where it did close under. But the gist was that there were strong buyers down here, strong buyers who wanted to buy this, anticipating that we break this range up. So this is again why I was bullish recently, because of this price action here. I wish I could say I caught this whole move. I did not, but caught enough of it. But say you didn't catch any of this move. Say you caught this move and then you got out. And you're saying, well, hey, I'll wait until we get back to this area. I'll just get back in. And you usually get those entries. You know, you really didn't leave much on the table, selling here, buying here. So always look for these smart pivots where smart money can just keep the trade going. So the next range I want to show you, and then we can wrap up here, is this range from the big swing high to this medium swing low. And I want to show you this because there's confluence or stacking with other sets of indicators. There's confluence with this larger fib from the high to the big low that we were talking about. So both of them have some pretty key levels right here. And this is why I am a little hesitant and why I did trim. I still think that we negotiate higher, but I got to be ready for the potential sellers in this optimal sell zone. So if this range is not ready to just surge up, there will probably be sellers that are coming in right in this zone. So as you can see, we did hold above it, but you know, it is a topping wick right into this zone. So it's just something to keep in mind. But I think this chart's a really good example because you can see the Fibonacci the ranges on the weekly and how they're kind of, interplaying with the daily range, and then we went into the little hourly range, this one right here, this extension range, and that's where I'm shooting for the short-term targets. So, yeah, there's a lot of factors that kind of get rolled in together, but it's really important to just keep in mind the bigger picture. So, Peter McGinn. So the golden pocket is just where the low wicks are below the 50%. It's a little more specific than that. Let me show you. So the 50% is important because it's just showing a division of the range and when it's on sale in the range and when it's going for probably more than fair value at the time, right? So that's where we were looking at those 50% wicks under here. But let me pull up Apple because it's a really good example. Here we go. So Apple had this big parabolic move, right? And then it just fell off a cliff for a few days. So when you have this range, you're looking for the golden pocket, which is the 0.62 fib, 0.78. It's that zone. So it's pretty deep in a discount under the halfway here. So because of that, traders who were looking to get long on this crazy move but couldn't justify chasing it, they were looking to buy in this zone. And as we can see, it really didn't get very far. It didn't even quite touch this. So that's a big sign of strength. But optimally, if you have this low to high range, this is the zone, the golden pocket where you're looking to buy a long. And we can just pull this up on any range and it'll be pretty darn effective. So we can reverse this and we can see that extending out, if you were trading this range, you got your 1.68 pretty darn quick, and then it even overshot that to the 2. That's another level I'll use. The 2 is a good fib extension, and then the 2.61 for, like, crazy parabolic moves. Yeah, those are my fib ranges. Feel free to take a screenshot or anything, or I can, always DM anybody who's interested, but these are the ranges that I use. Yeah, no problem, Peter. Thanks for asking. So one more thing while I have this chart up, let's test our golden pocket strategy. Let's back test it real quick. So we have this swing high and this swing low. There you go. Look, you can put this on any chart and you'll see it happening. It surged up, and then this was the optimal little take, like kind of tranche out zone or take profit zone. If you were buying down here, hey, we're close to the top of the range. Very rarely do you get straight V moves straight out of a range. Usually they need to consolidate, right? And that consolidation, pattern traders would view that as a pennant or a flag, right? So lower highs, lower lows as price compresses. So what's happening there is we have kind of overshoot and exuberance to the upside and then to the downside. And then from there, price starts achieving fair value. Like the buyers and sellers are negotiating back and forth, saying, okay, we got a little overboard when we sold it. Obviously, it's worth more than that, but I'm not buying that it's going higher yet. So they're fighting back and forth, and price compresses. And so then, if it's a bullish chart, what you'll see is price gets tighter and tighter and tighter, and then they'll find out there are no more people at this equilibrium or under the equilibrium, under this red line. There are no more people down here that want to sell. Everybody who said, "Hey, I think it's going," like basically, there's only bulls left, right? And then they're going to start bidding each other up because they still want to buy the thing. They think it's going way up here, and if they can't get it at a discount, they'll start bidding, 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 bidding. So I just wanted to show this range here because we came up and this was a logical place to sell. Then you get the price compression. What are we doing? We're watching in this golden pocket for a positive reaction. And boom, right there, it wicks in and then says, no, sir, we're going higher. And then surges up. And at the same level, people are still taking profit. So not everybody's convinced. Or more realistically, even if it's going higher, there still will be moves up and down in any range. So this is where being really agile really pays off. You can get long right here, sell right here, watch the next fib down and say, okay, look at that. I bought a wick off this fib. I sold up here, I'll get a little discount. I'm taking a little bit of discount from here. Instead of getting dragged, I'm getting out here, getting in here again. And then it's acting right, it's consolidating through. Time to shoot for the high range this time. Then we use our extensions that we talked about, and we target the upside. So if it's a fake breakout, maybe just the 1.27, and maybe that's all you get. And if so, then you take some profit there and you watch the one or the previous high. And if that backtest holds, you can get back in. No worries there. And then you would be shooting for this 1.68. And this is such a strong move, it just surged right through. If you're getting this surging action through this, you can target the 2. Really crazy move, you look for the 2.61, but never expect the 2.61. That's just like that's a cherry on top, right? That's just like perfect trade. Hey, every 1 out of every 10, 20 trades will be like this, but you can't expect it. So that's kind of what we're working with here. There's a lot of variables here. I know I kind of threw a lot at you, but I tried to kind of hammer home the most important parts. So make sure you're trading an established range. Always keep an eye on the golden pocket. Always keep an eye on what the difference in price action is at a discount under the 50 and at a premium over the 50. So using all of this, you'll be able to predict the breakout of the range, and then you use our Fibonacci extensions to target that. So I hope this helped a little bit. Thanks again for bearing with me through the technical difficulties. I promise next week will be smoother. I'm going to drill this stuff this weekend. But I had a lot of fun kind of presenting this stuff to you. And I think that there's a lot of value to just mess around with this stuff. Throw them up on your chart, see how it goes. I bet you'll find a lot of actionable information. So let's see. Looks like I've not seen any more questions, so I'm going to wrap this up. But I will be hopping over into the Discord server, Trade the Pool Discord server, and I'm happy to hang out there for 10, 15, 20, let's call it half an hour if anybody's there. And we'll go over charts that you want to go over. You can ask me more in-depth questions, whatever you like. Thanks so much. I will be back next week with more information. Take care now.